Imagine protecting your portfolio when inflation spikes, recession looms, or even if the dollar weakens, and still coming out ahead. That's the power of hedging. You boost your upside while limiting your downside. Instead of being at the mercy of the market, you build a cushion that keeps you in control. Inflation hedge. The problem: inflation erodes your purchasing power and eats into fixed income returns. The hedge: Treasury inflation protected securities, TIPS, commodities, energy, metals, agriculture, stocks in sectors with pricing power, utilities, consumer staples. Effect: your portfolio rises with the cost of living instead of shrinking against it. Recession hedge. The problem: in a slowdown, corporate earnings decline, unemployment rises, and stock prices fall. The hedge: defensive stocks, healthcare, consumer staples, utilities. High-quality bonds that often rise when stocks fall. Cash reserves to scoop up bargains when others panic. Effect: you stay liquid and stable while others scramble to survive. Lack of confidence hedge. The problem: when markets lose faith in leadership, currencies, or institutions, volatility spikes. The hedge: gold and silver as historical safe havens, Swiss franc, US treasuries, or strong foreign government bonds. Volatility indexes, VIX futures options as direct insurance. Effect: when uncertainty rattles others, your safety assets shine. Collapse of the dollar hedge. The problem: a weakening dollar makes imports costlier and lowers your global purchasing power. The hedge: international equities, Europe, Asia, emerging markets. Currency ETFs, euro, yen, Swiss franc. Hard assets like real estate and commodities. Effect: as the dollar falls, your international positions rise, turning weakness into opportunity. Stock market crash hedge. The problem: sudden crashes can wipe out years of gains in days. The hedge: put options on indexes or ETFs, insurance against drops. Inverse ETFs rise when markets fall. A barbell portfolio: keep safe assets on one end, growth on the other, and avoid the fragile middle. Effect: losses in stocks are offset by gains in your hedge, keeping your net portfolio intact. Peace of mind. Your investments are no longer a gamble. They're protected by layers of safety nets. Opportunity mindset. Cash and hedges let you buy undervalued assets when others are forced to sell. Steady growth. Instead of swinging wildly with every headline, your portfolio compounds steadily over time. Bottom line: by mastering hedge positions, you don't just survive inflation, recessions, or market shocks. You position yourself to profit from them while lowering your overall risk.